So with regard to the PE valuation method, there's an interesting little blurb here about the problems that go with it. And it's fast and easy, as they say, but PE ratios vary over time. So an interesting note here, in 1980, the average stock had a price-to-earnings ratio below 9, but by the year 2000, the ratio rose to above 40. So anyway, so if you compare it over time, you're going to get a lower estimate of value for stocks than what would have been used 20 years later. So there's some issues with it. So basically, the method is going to depend on a lot. All right. So it's going to depend on whether stock market valuations are generally high or low. So every model has its problems. All right, so here's an interesting, nice little slide here. The financial manager makes a decision which will affect the expected return, and will affect the risk measured by the required return. The required return is different than the expected return. This is what you actually require, but in reality, this is what you really expect the company to give. There's a big difference between expected and required return, and you should be aware of that. And you'll notice over here that here is your required return, right? And this is the effect on the stock value. So please make a note that expected and required return vary very greatly. So as I mentioned before, expected dividends, any management action that causes stockholders to raise their dividend expectations should increase the firm's value because more people would buy that stock, right? And as long as there's no risk, but a lot of times they try to keep the dividend stream as constant as possible to avoid any bad feeling about why is this changing so much, even if it goes up or down. All right, so here's an example in your book, simply that goes over the dividend and why it would, if the value of the share goes up based on the expected future dividend because of the increase in the growth rate. So you can see here the growth rate is increasing from 7 to 9. The dividend remains at $1.50. And the resulting share price has gone up to $25 here, and it was $18.75. So you can kind of see that. All right. So a recall from if we went back to chapter 6 when we were talking about interest rates, previous chapter, the nominal rate is the real rate of interest, right? And here's the inflation premium. And here is the risk premium above the risk-free rate for this particular company, okay? And this equation also will hold for bonds too. There's a risk premium, right? So you can apply this equation across the board for different securities. So basically, risk is going to be a product of the financial manager's decisions, and that may reduce the value of the stock or the value of the company, and cause people to get a little concerned. Okay. Okay. So again, here's an example of risk. And you can see we calculated that the stock in example 7.3 was $18.75. Now, the financial manager makes a decision that without changing expected dividends, causes the firm's risk premium to increase by 12%. So now the risk premium has gone up. Assuming that the risk-free rate remains at 4, the new required return on the stock is going to be 16%, right? So here's your required return. 4% plus 12%. And here's the dividend. And it's 16%. And here's the growth rate. So now you'll get a new share value of 1667. As expected, right? The required return has gone up without any corresponding increase in expected dividends. So the stock market's value declined. So this is one way financial managers have to be real careful when they make decisions. So a couple points here. As firms take on more risk, their shareholders expect to see higher dividends, correct? And the net effect on value depends on the relative size of the changes in these two variables. All right, so here's another example. And you'll notice simultaneously the key variables are going to change. D1 will be $1.50. The required return is 16% and the growth rate is 9%. So you sub that into the valuation model and the share price now has gone up. So the share price increased from $18.75 to $21.43. So even with the combined effects, the decision appears to be in the best interest of the firm's owners because it increases their wealth. So you got to basically force the dividend to go up if the required return goes up too. All right, well, that's it. So if you have any questions, just email me, okay?